Would you put all of your hard-earned money, your portfolio, into just 7 companies? Well, of course not. That'd be crazy. We want diversification, right? That's what's pumped and promoted all over if you know anything about investing, which I'm assuming you do. Diversification helps protect your portfolio from the ups and downs of the market. However, the S&P, if you really look at it, is not very diversified.
While the AI boom has delivered impressive returns, concentrating your financial future on a handful of dominant players like nvidia and Amazon is a risk that serious investors simply can't afford to ignore. Which is exactly why building wealth beyond the S&P 500 isn't just smart, it's necessary.
I think set it and forget it is no longer as applicable if your entire portfolio for retirement is in the S&P 500. Even regardless of what's happening in the AI market, it really isn't well diversified.
In this video, I'll show you why the S&P 500 is not actually that diversified, why you should invest your portfolio beyond the S&P 500, and give you some solid research-backed recommendations that I personally invest in to help really diversify your portfolio and help protect your financial investments.
The S&P 500 is what's called a market cap weighted index. That means bigger companies have a bigger influence on how the index moves. Therefore, if investors are driving up a stock's price, that can increase the company's market cap, which will then increase the company's weight in the S&P 500. That's one of the reasons why the S&P 500 has become so heavily driven by AI and tech giants.
In case you're new to my channel, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada, and I've been investing for just over 20 years. If I can't explain it simply and practically, I don't recommend it. Here's why the S&P 500 isn't actually that diversified if you delve into the data. It's completely made up 100% of US companies. It's priced in US dollars, and a large portion of the S&P 500's performance comes from just 7 companies, the Magnificent Seven as it's known. Apple, Microsoft, nvidia, Amazon, Google, or Alphabet, Meta, and Tesla.
It's now more than 7% of the S&P 500. That means that one company now carries as much sway in the S&P as the bottom 224 stocks combined.
Together, these 7 companies make up roughly about 25 to 30% of the S&P 500's performance. So a big part of that return that you're getting is coming from those 7 Magnificent 7 companies. Now, don't get me wrong, these are amazing companies. However, the risk is that, say, 2 of those companies, or maybe even 3 or 4, don't perform, have a bad year, well, your portfolio will reflect that. The risk is because you're investing heavily into tech. That's what a lot of these companies are. Microsoft, Tesla to an extent, nvidia to a large extent, Apple, they're tech companies. Well, what happens if the tech industry experiences problems? Most investors aren't betting solely on the US economy as a whole. They're betting actually just on these 7 companies to continue to perform. Index 1, total US stock market. So what exactly does this mean? Instead of only owning the largest 500 companies in the US, you get to capture the growth in this index from every publicly traded company in the US, large, medium, and small. So you get to capture the growth and future performance from all these small companies if they will one day become the next nvidia, Tesla, Microsoft, Apple. So imagine the possible returns. So the best example of this, VTI, Vanguard Total Stock Market. This has an extremely low fee, low management ratio, has long, strong, proven performance, and does experience a little bit of volatility, but is actually more complete than other indexes. Number 2, ITOT, iShares Total Stock Market Index, nearly identical exposure. If you believe in the US and its future performance, this is a more honest and practical way to capture the entire market. In case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, and investment portfolios. I try to relate and be the voice of the middle and working class in Canada the best that I can, giving them real, solid, practical advice. If this sounds like something you'd be interested in, consider subscribing to my channel. If you truly want to invest beyond the S&P 500, the first step is to understand different market indexes. These include the Wilshire 5000, the Dow Jones US Total Stock Market Index, the CRSP US Total Stock Market Index, and the S&P Total Market Index. While the names might sound a little funny and unfamiliar to you, these indexes do the same thing as the S&P 500 does, in that they track indexes instead of the top 7 largest or 500 largest companies. They track nearly the entire US market, giving you exposure to large, medium, small, and even micro-cap stocks. While the returns and performance can be nearly identical, there are special differences because you're now exposed to a wide variety of companies, helping shield you from market fluctuations because you own smaller businesses beyond just the 7 or 500 largest companies. This matters due to market cycles. Now, for clarification, you don't invest into these ETFs directly, you're investing into indexes that track them. For Canadians, some of the best low-cost options are US-listed ETFs like Vanguard Total Stock Market ETF, VTI, which tracks the CRSP Total Market Index and charges just 0.03%. iShares ITOT, which tracks the S&P Total Market Index at the same low cost, or Schwab SCHB, which tracks the Dow Jones Broad Market family. These are extremely liquid, widely used, and very efficient. If you prefer a Canadian ETF that trades in Canadian dollars, XUU from iShares is a popular choice. The fee is slightly higher, but still reasonable, and VUN from Vanguard is another option. Key idea here is that you're getting exposure beyond the S&P 500, helping protect your portfolio.
So if you're investing in the S&P 500 index in particular, and you're concentrated in that, you run the risk of having losses that might interfere with your personal timeline, say retirement or another investment goal.
The real, true investor, like I always believe in, is looking for strategies that are simple, but truly diversified. A total market ETF can help spread your portfolio across the entire US market rather than simply relying on one narrow slice of it, helping you truly diversify. Over long periods, you will see differences. Sometimes these ETFs will lag the S&P 500, sometimes they'll pull out ahead. But the real win is that you're diversified and protected from market fluctuations. For Canadians, just be mindful of where you hold these ETFs. US-listed ETFs often make the most sense inside an RRSP, while Canadian-listed versions can be simpler for TFSA and non-registered accounts. Bottom line, investing beyond the S&P 500 isn't about chasing trends and fads. It's about truly diversifying, keeping it simple at a low, manageable cost. The number 2 index, Developed International Markets, EXUS. This index owns large, established companies outside the US. Think Japan, Europe, Australia, South Korea. These markets won't always beat the US, but they will win at different times, helping smooth out your portfolio ride. If you want a simple play, VEA is a very low-cost option, giving you broad exposure to developed markets. Another option is VXUS, which gives you still exposure to developed markets, but broadens it more into emerging markets, helping increase your diversification for a slightly higher fee. Bottom line, it's not about beating the US, it's about developing a portfolio that isn't dependent on it. Index 3, Emerging Markets. Emerging market indexes buy into fast-growing companies. Think of China, Brazil, India, and parts of Southeast Asia. Younger populations, growing middle classes, higher long-term growth potential, and yes, more volatility. VWO is a low-cost choice focused on long-term growth. IMG, all these acronyms, is a little bit more broad if you want extra coverage. Now, expect some rough patches with your portfolio because emerging markets don't ride smoothly all the time because they're emerging, so they'll hit their ups and downs. That's to be expected. However, you're building a multi-decade portfolio. In case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, and investment portfolios. I try to represent the voice of the middle and working class the best that I can. And all of my information is highly researched back and proven with data. If this sounds like something you'd be interested in, consider subscribing to my channel. Index 4, Real Estate, REIT Index. REIT indexes let you own income-producing real estate, such as apartments, warehouses, data centers, and hospitals, without buying the buildings yourself. They tend to pay steady income and behave differently than stocks do, which helps protect your portfolio. For real US real estate exposure, consider VNQ. And for a global footprint, try REET. Real estate isn't a magic return booster. It's just simply a different engine that helps reduce the bumpiness and smooth out the ride that you're getting in your returns. Index 5, the NASDAQ 100. The NASDAQ 100 is all about innovation. Tech, AI, semiconductors, platforms. It's high growth, high risk, and very concentrated in just a few solid names. QQQ is a classic choice, and QQQM is another option with a slightly lower fee for long-term buy and hold investors. Now, this is not diversification, but it is an accelerator designed to boost your performance. Index 6, bonds, the stability piece. Bond indexes buy corporate and government debt. The job of bonds isn't to make you rich, it's to protect your portfolio when stocks crash. If you want simple, look at BND for US bonds or BNDW for a global bond mix. Bonds are made boring on purpose. They're meant and put in there to help smooth out and calm your portfolio through the ugly years that nobody wants to see. So how Canadians actually buy all these indexes? A simple explanation. A lot of people are confused if a Canadian can buy US ETFs. Yes, Canadians can buy US ETFs such as VTI, QQQ, and so forth through online brokerages and platforms such as Wealthsimple, Questrade, Interactive Brokers, and all the big banks that do. However, there are risks because US ETFs are bought in US dollars. There's a conversion currency, so hence a conversion risk. So if the loonie falls, your investment portfolio is at risk to some degree because of that conversion rate. Make sense? Taxes are different for accounts. The RSP is best for US ETFs. The TFSA can suffer tax dividend withholding, and taxable accounts can involve extra paperwork, which is why many Canadians prefer the Canadian ETF version as opposed to the US ETF. So you know, buying the Canadian ETF helps reduce the currency conversion risk and simplifies taxes. But of course, being in Canada, you pay usually a slightly higher management fee. But remember, with whatever path you choose, you're not choosing better or worse. You're choosing whatever path works for you that is simpler and more clear. A helpful tip for you that you probably already know is reducing risk isn't about buying more tickers and more stocks. It's about buying investments that behave differently at different times. Now, don't get me wrong, as I'm sure I'll get comments about this. The S&P is great and provides very generous, great returns for most investors. However, if you truly want to diversify, you should eventually be looking beyond the S&P 500 for a strong investment portfolio.
So experts always say to have a diversified strategy. There may be times when the S&P 500 does better, and then there may be times when international stocks, value stocks, small cap stocks do better.
Spreading a core between total market, international, emerging, REITs, and a stability piece gives your portfolio more ways to win over different cycles. The S&P 500 is a great engine. However, it's not a seatbelt to protect you against all the turbulences in the market. Long-term investing isn't about picking the winner. It's about surviving long-term market cycles and fluctuations. Like I said, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. And if you want real investing and not just hype, you actually want practical solutions, consider subscribing to my channel, as I'd love to have you as a subscriber. And I'd like to give a quick shout out to 3 of my long-term followers, viewers, commenters, No Breaks, Liam, and Aaron Banks. Thanks so much, guys, for all the support. I really appreciate it.
Oh, you know I'm right. Like Sunday has you mad. Tear me up just somebody less refined.